In today's video, I'm going to share with you guys exactly how to write off your business vehicle if you are a business owner or a real estate investor. What's going on, guys? My name is Shamyr Borgelin. I'm a tax strategist and advisor for entrepreneurs and real estate investors, teaching you how to keep more of what you earn. And in today's video, I'm going to give you the step-by-step guideline on exactly how to write off your business vehicle if you're an entrepreneur or a real estate investor. As an entrepreneur or investor, let's face it, you need a vehicle to get around, to meet your clients, to attend seminars, and to probably check on one of your investment properties. But how do we write off the vehicle properly and not be scared of the IRS? So we need to follow certain guidelines to make sure that we're being compliant, but yet maxing out our deductions. So we're going to talk about it in today's video. Now, before I go on exactly how to do it, we need to start off and explain exactly what is a reasonable and ordinary and necessary deduction. Now, that is section 162 that the IRS states to us. We can write off anything as long as it's reasonable, ordinary, and necessary for the pursuit of income for our business. So, do you need a car for your business to meet clients? I think that's reasonable, ordinary, and necessary. Do you need it to go check on your properties? I think that's reasonable, ordinary, and necessary. Now, we need to figure out the business portion of the vehicle in order to write it off. So what I recommend is really tracking your data and your vehicle usage throughout the year so we can determine the business portion of the car. So if you drove 10,000 miles in the year, what percentage of those miles were actually business and what was personal? So if you drove 5,000 for business, but 5,000 for personal, that means only 50% of that car was for business. And we can use the 50% as a deduction. The other 50% that's personal, we cannot use. So the best way to track our business miles is going to be utilizing apps like Mile IQ or QuickBooks. They provide options for you to utilize so that every time you get into your car and you go over a certain miles per hour, it'll track your miles for you. Makes it super easy for you and for your bookkeeper if you have one. Now that we got how to track your business miles out the way, we need to talk about exactly how to write off the business vehicle. The IRS, they give you two ways to write off the business vehicle, either the actual method or the mileage method. Now, we can't use both. We need to find out which one is going to give us a higher deduction amount. And the way we need to do that, again, is by not only tracking our miles, but by tracking our expenses. And this is going to be useful for the actual method. So let's go ahead and look at this screen to see exactly what the actual and mileage method is. We're going to start off with the actual method. Now, the actual method is exactly what it sounds like. The actual costs associated with the business vehicle. You see, the IRS, they say that as long as you track all the expenses that are related to the vehicle, you get to write off the portion of the business usage. So you guys need to keep track of all of your expenses throughout the year, especially related to your vehicle if you plan on writing it off. Now, apps such as QuickBooks is going to be super important for you to track your expenses and come up with the total cost of your vehicle. Now, the actual expenses that come along with your vehicle are some of the following: depreciation, payments on your vehicle if it's a lease, insurance, maintenance, repairs, tolls, gas, etc. Depreciation. Let's talk about that. Depreciation is essentially writing off the value of the vehicle or your asset over a certain time period. For vehicles, the IRS, they say that you can write off the value of the vehicle in 5 years. So if you buy a car for $50,000, the IRS says, hey, Lisa, at $50,000 vehicle, you can write off over 5 years. So that means essentially you get a $10,000 write-off that you get to use every single year for 5 years just off the value of the car, plus the insurance, the maintenance, repairs, tolls, and gas. Now, you can't write off the car payments of that vehicle unless it is a lease. Now, if it's a lease, you can write off the payments of the vehicle, but you can't depreciate the value of the vehicle because the car is not yours. It's for the dealership or for the lender. But you get to write off the business portion or the business usage of those car payments throughout the year, plus the insurance, the maintenance, the tolls, the gas, etc. So that's how you'll determine which option to go, whether to buy or lease a vehicle. If you're a business owner or entrepreneur looking to keep more of what you earn, you need to determine which one is going to give you the bigger tax benefit, leasing or owning. And that's why meeting with a tax strategist or advisor is going to be super important, like our company, CEO Haven. Now let's get back to it. With the actual method, again, we need to keep track of all of our expenses throughout the vehicle and see how much that is. Now, with the mileage method, this is going to be more useful for my Uber and Lyft drivers or for my realtors. So people that are really on the road a lot, this option is going to be more useful for you. Now, as of 2024, the IRS states that you can write off 67 cents per business mile that you take throughout the year. So now that we know that, how do we determine which option is better for us? So what we're gonna do, an example of 10,000 business miles driven throughout the year. So Lisa here has two options to choose from. So she has a business vehicle and she uses depreciation. She uses her gas, maintenance, and repairs to come up with her actual cost. Now the actual cost is going to be $10,000 for the whole year. Now her miles driven throughout the year was 10,000 miles because Lisa is a real estate agent making a ton of money. So since Lisa drove 10,000 miles and all of it was for business, we can now multiply that by 67 cents per mile. So if we do that multiplication, we get $6,700. Now we can see here, comparing and contrasting on this menu, on this screen, sorry about that, that Lisa has a higher actual amount, and she has an actual amount higher for about $3,300. So it's clear that we need to take the actual method when it comes to taking the expense. And this is if Lisa used the car for 100% business use. So you would need to tailor it for the business usage that you would take for your car, AKA going back to Mile IQ and seeing how many miles you drove for business versus personal. And you would just multiply that figure based on the actual method versus the mileage method. Now, I'm going to talk about something for my heavy hitters. If you're really looking to maximize your money when it comes to buying a business vehicle, one of the best strategies that you can use is Section 179, aka bonus depreciation. This is one of my favorite strategies to employ because I'm an avid car lover, and you are probably too if you're watching this video. Section 179 states that if a business vehicle is above 6,000 pounds and you use it for more than 50% or more for business use, we can write off up to 60% of that value just in 1 year. Now let's give an example. Let's say Lisa bought a Range Rover for $100,000. If Lisa bought a Range Rover for $100,000, that means we can write off up to 60% of that value just in year one. If we did that and we did 60% of that $100,000 car purchase, and mind you, you don't need to buy it in cash. You can just finance that vehicle with as little as zero money down or up to 10 to 20%, which is standard. So just by putting zero money down or 10 to 20%, you can finance and write off the entire purchase price of that vehicle. So that means in this example, we get to write off $60,000 in year one. That's a crazy amount, right? So let's say that Lisa made $100,000 in income throughout the year, and she got this Range Rover to improve the appeal and the aesthetics in her brand as a high-end real estate agent. Would that not provide a better outlook or better aesthetic in this world of Instagram that we're in and YouTube that we're in? People are more likely going to take you serious more serious because of how you present yourself. And that can translate into making more and more money. So if Lisa got this Range Rover making $100,000 and we're able to take a $60K expense, we're left at now a $40,000 of taxable income. Now, I don't know about you guys, but I'd much rather be taxed at $40,000 than at $100,000. That's a lot of money that we get to save in taxes that we can apply to our car payment, or that we can reinvest into our business and put more money into ads, or we can use that money as a down payment onto a rental property. So the point is, rather than giving this money to the IRS and never seeing it back, why don't we reinvest that money back into ourselves, back into our business, so that we can make more money? So that wraps it up in today's video on exactly how to write off your business vehicle, the actual method or the mileage method. I hope you guys found value in this video. And if you guys are a high income earner or entrepreneur, I highly recommend that you guys meet with our team so we can see if we can save you 15K or more on your tax bill. It's completely free. It'll take 15 minutes or more to decide if you guys are a good fit in working with us. I hope you guys found value in today's video. And if you did, please hit the like button, comment, subscribe, and I'll see you guys on the next video.